If you didn't notice, the real estate landscape has changed. Prices have dropped, houses are staying on the market. Everything is different than it was a few months ago. Interest rates are soaring through the roof. If you aren't leveraging these three things outside of your cash, then you need to watch this video. The first thing we're going to cover is investing your equity. The second thing we're going to cover is investing in 1031 exchanges. And the third thing we're going to cover is investing in your retirement account. Number one, investing your equity. Stocks, mutual funds, ETFs, maybe you've had a good run up over the last decade and you don't want to sell them and realize your gains, have a big tax hit. What you can do is go to your financial institution and ask them if they offer a line of credit based on the assets that you have in your account. A lot of times there's fees and minimums. One example is Charles Schwab. They have a pledged asset line, it's called. I know when I was working there was a $200,000 minimum and fees associated with opening the account, I'm sure. But whatever financial institution you have, check with them to see what the details are because I don't know. And then there are also third-party bankers that will come in and offer you maybe a little bit of a higher interest rate, but nonetheless give you a line of credit based on the assets that you hold in that account. As always, like and subscribe if you're getting value out of this content. Thanks. Number two, investing with 1031 exchange monies. A few investors have asked me lately if we are 1031 exchange friendly when we run syndications for large multifamily projects. Let's outline what it means to be 1031 exchange friendly, the benefits of this for our investors, and the complexity it adds to the structure of a deal, why a lot of syndicators don't offer it. If you're considering a syndication as your next investment to park 1031 exchange money, make sure the syndicators offer 1031 exchanges to their investors. P.S. We are 1031 exchange friendly. As you probably know, 1031 exchanges allow investors to take a profit from appreciation and buy another similar real estate asset of equal or greater value with the profits from the original asset. This allows tax on the gains to be deferred. That's huge. Think about it. If you're taxed at 20 to 50% every time you cash out, wouldn't it make sense to try to build as many gains tax deferred as possible? In order to qualify, the investor needs to identify up to 3 properties of equal or greater value within 45 days and purchase it within 180 days from the sale of the original property. The investor needs to use a qualified intermediary. The investor never touches the cash from the sale, or the entire 1031 exchange is null and taxes will need to be paid for that year. If the investor sold the property with $100,000 in equity, but they still had $100,000 of debt on the property when they sold it, they need to take on the $100,000 in debt on the new deal in order to meet the 1031 exchange requirements. The investor needs to inform the syndicator they require $100,000 of debt in the deal. In a traditional syndication, 70 to 80% of the deal will be bank financed. Let's say, for example, the purchase price is $10 million and the bank is requiring 25% down, or $2.5 million, and they're issuing $7.5 million in debt. In order to get the 1031 exchange done, the investor needs to take on and sign a promissory note with the bank stating they are responsible for $100,000. There is complexity to this, but as long as you plan for it, it's well worth it in our opinion, and that's why we offer it to our investors. Number 3, investing in your retirement account. Did you know that you can invest in actual assets like an apartment building syndication or a rental property in a self-directed retirement account? If you're self-employed and don't have any employees who work more than 1,000 hours per year for you, you qualify for a solo 401k. If you don't own your own business or you do have employees, the best option is to open a self-directed IRA. The main advantage to a solo 401k is contribution limits. For 2022, you can contribute a whopping $61,000 and an extra $6,500 if you're over 50. For a self-directed IRA, it is only $6,000 annually or $7,000 if you're over 50. So, how do the logistics work if you want to invest into a syndication with retirement funds? Well, you open a self-directed retirement account with a custodian who allows real estate assets to be held. You fund the
the self-directed retirement account. You can transfer money from a former employer, traditional or non-Roth IRA, SEP IRA, simple IRA, or if you're eligible, you can make a contribution to the solo 401k or self-directed IRA. This is typically something you can get done in 5 to 10 business days. Step 3, invest your money into a real estate deal, which is easily done through your custodian. It's really that simple, folks. There are a few legal guidelines you must follow throughout this process because you're investing in a retirement account. Always happy to refer you to the custodians we recommend so you can discuss in more detail. In my opinion, self-directed retirement accounts for the win.
As always, like and subscribe if you're getting value out of this content. Thanks.